Happy Friday, everybody. Mike Sorrentino here, and we are knee deep into April. So let's talk about some of the things that are going on in markets right now. The first 3 months of the year were quite exciting in the fact that they weren't. There was nothing going on. The market just went up seemingly every day. It was a great first quarter of the year. Since then, we've seen a little bit of a reversal. So let's talk about what we think is happening here. I wouldn't say it's a great quote from Jerome Powell, but it's a telling one in terms of what's happening in markets. He was quoted recently saying, "The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence." Translating that into English, what that basically means is that he is not expecting to cut rates anytime soon. We talked a little bit about this late last year and in our State of the Markets about how we were skeptical that that the Fed was going to meet the expectations of the market. At the time, the market was expecting several rate cuts this year, a dramatic drop from January to December, and it doesn't seem like that's going to happen anymore. In fact, a couple of weeks ago, the target had been revised down to only 3 cuts this year. I would actually, at this point, I think what we're starting to see get priced in the markets are no interest rate cuts through the end of the year. And why does that matter? It matters because the market, the stock market, does not like higher interest rates. It just doesn't. We saw that in 2022, and a lot of expectations that were maybe baked in might not be happening this year. So there's been a bit of an adjustment. I showed this graph a couple weeks ago in our last week market update. This is the VIX, the VIX, the volatility index. It's not a perfect measure of volatility for stocks, but it's not bad either. And my point here was that this is a mean reverting index, meaning that when the volatility is lower than its average, in this example a couple of weeks ago, it was down to 12.9. That's below its 19 long-term average. You tend to see volatility rise to its average. When it's above its average, you tend to see it fall over time. That's what we call a mean reverting index. And my point was, this can't last. All right, not because I thought something bad was going to happen imminently or anything like that. I just said, look, this just doesn't happen. Markets just don't go up the stock market doesn't go up all the time. And we don't want it to, okay? We don't want it to go up all the time. I know it sounds great on paper, but when that happens, guess what happens after 2022, all right? So 2021, the market just went up all the time for no reason, all right? 2022, it corrected itself. So we like to see these air pockets, this kind of pressure release happen throughout the way. And I think that's what we're seeing to a degree right now, all right? Nothing lasts forever. It just doesn't. If you look at the bottom part of this chart, that's the S&P 500, the Russell 2000, which is a small cap stock index, small companies in the US, and then the the S&P 500. All 3 major indices are down quite a bit since April 1st, okay? Whereas the blue line is the VIX. The VIX has spiked. It's up 33%. That might sound scary, but that's actually still well below its long-term average. So we're seeing this I don't know if it's going to be a correction or not, but we had such a strong first quarter that we're giving back some of it right now. Now, in my opinion, and again, I'm not a big time market tracker or short-term trend follower, but my opinion on markets is that these are healthy. We need to see these types of events happen, because if they don't, then the market gets too far ahead of itself, too much euphoria gets priced in, and things get a little wonky. So I'm not seeing anything right now that's necessarily making me nervous per se. In fact, if anything, we're in the earnings season right now. And if you look at the economic data and what's coming out of earnings, although it's still very early in the season, not seeing any kind of warning signs. We are seeing that continued bifurcation of the economy where some parts of the economy are okay or fine or somewhat good, but there are also other parts where that's not so good, right? And we're starting to see some parts of the economy and some parts of consumer spending weaken along the way. And I just want to put this drawdown into perspective. It's a great chart from Charlie Bilello over Creative Planning. He's showing that the intra-year drawdown, so that basically is throughout every year, how far did the market pull back in any given year? And so far, we've seen the market pull back about 2.5% through April 12th. Okay, so it's a couple of days past that. We've seen a little bit more of that since then. But my point here is, even though down maybe 6 or 7%, whatever it might be, relative to historical drawdowns, even at a 6 or 7% drawdown, it's nothing compared to what we're normally seeing in prior years. Okay, so my point here is that what we're seeing right now isn't anything so far that I would even be close to viewing as alarming. This is just naturally how markets work. And like I said earlier, I think it's a good thing, because I don't want to see markets go up all the time, because then things get really weird. But why is this happening? It's going back to Jerome Powell's quote at the beginning of our webinar here. It's happening because interest rate expectations are changing. It's happening because this is the 10-year Treasury rate. The 10-year Treasury bond is a very important interest rate in finance, and it's used for a lot of things like pricing different types of loans and whatnot out there. So it's very closely followed. And when the 10-year Treasury falls, like I did on the left-hand side of this chart, when that rate falls, it tends to be a sign that people expect interest rates to be cut. Okay, so what's happening behind the scenes? If I own a short-term bond and I think interest rates are going to come down, what I'm going to do is I'm going to sell that short-term bond. I'm going to make it up. Let's say it's a 2-year bond, or maybe a 1-year bond. I'm going to sell that bond and jump into a 10-year bond. The reason why I want to do that is because that 10-year bond is going to give me a higher rate of return. And that way, if the Fed cuts interest rates, that 1-year bond that I have to reinvest into a lower rate when it matures, I'm more protected in that 10-year bond. I know that's a little technical, a little confusing. If it is, don't worry about it. It honestly doesn't really even matter all that much. But I'm just going to give you an idea of what's going on behind the scenes. But what we've seen since then is the yield rise. All right, since January this year, the 10-year Treasury yield has been rising. That has been happening because slowly over time, expectations of interest rates falling have been changing. We don't think they're going to fall as much anymore. So what you're seeing are people starting to sell that 10-year bond and move into shorter-term bonds because of the more attractive yield. When that happens, that tends to disrupt the stock market, because now we're starting to see a 10-year bond in this example yielding 4.6%. If you compare it to call it the earnings yield, or even the dividend yield, however you want to compare it to the stock market, the bond market is starting to look a little bit more attractive. And now that we've got rates higher for longer, most likely, I just want to kind of shift gears somewhat and discuss what we're seeing here. This is a great chart that I found in the Wall Street Journal. The effective federal funds rate, that's their target interest rate, is just below 5.5% right now. But look at the bottom line. The national average rate on savings accounts is still below 0.5%. What gives? I checked my Bank of America personal checking account. I'm even lower than that. All right. But what I do is, for my excess cash, or my cash that I don't want to invest in the stock market or anywhere else, I actually use a cash solution for that that's yielding right now about 5%. It gives me full daily liquidity. I can move in and out anytime I want. All right. There's a couple of these out there. All right. There are options to put your cash to work. Money market funds. There are numbers of different ways where your money can work for you, that you don't have to lock up in a bank CD, or you don't have to keep in a checking account or your brokerage account that's not paying anything right now. So all of those things right now, if you think about it, these are options. All right. I'm not saying run to cash. I'm not saying, oh, the market's volatile, run to cash. What I'm saying is that in your financial plan, that portion that actually should stay in cash for operational reasons or whatever it might be, rainy day funds, there are some options right now that are yielding very attractive returns. Now, admittedly, when you back out inflation and taxes, you might just be breaking even, but at least it's something. At least you're keeping up with the rate of inflation right now, which is stubbornly high. So this is just a reminder. If you're sitting in cash, there are some good options right now that still provide daily liquidity. And I just want to end with a throwback to the past. Let's go back to 2021 mania. If we can remember that far back at this point, all those meme stocks, right? Bed Bath Beyond, The big one was GameStop, right? GameStop was a really interesting one. They made a movie out of GameStop and the short squeeze that we saw that year. All these different crazy meme stocks. What I mean by memes is that they were popular on YouTube, popular on X and Twitter, and different social media forums. And we saw them trading completely unrelated to the fundamentals of their underlying business. Hertz isn't even on the list. Hertz went bankrupt, and their stock was still trading in bankruptcy. All this craziness, all this excitement, all these people talking about getting rich at the time. What happens 3 years later? And as you can see, it has not been very good. Bed Bath Beyond is bankrupt. They're gone. Blockbuster, I don't even know how they're still around. They're kind of like Radio Shack. But some of these other ones, like, look, AMC down 99%. 99%. At one point, that stock was trading like crazy every day. Okay? So, again, this is not meant to make fun of the stocks or the people that own these stocks. Far from it. What this is a reminder that in the short run, in the short-term markets, anything can happen because emotions run the prices. But when it comes to the long run, 2-3 years down the road, fundamentals always matter. And as you can see, most of these stocks didn't have the fundamentals to support the prices that we were seeing not that long ago. So with that, I will leave you. Thank you for your time, and we'll talk in a couple of weeks.